External reconstruction of companies. For topic, myself Dr. Naneshwar Marathe, Head Commerce and Management, Pratap College, Amani. To know the external reconstruction, basically reconstruction is happen when the existing company come in a financial crisis. In such a situation, the external reconstruction is happen and procedure made by the management of the existing company to basically know about the external reconstruction. In such a case, external reconstruction is a corporate restructuring of the business. In such a case, the old business is technically liquidated and new company formed. In such a case, the old company's assets and liabilities taken over. It's usually normally undertaken at the by the old company in a financial crisis or weak. There is a loss in the business. In such a case, the external reconstruction will be process going towards the external reconstruction. In such a base, in such a situation, long term business objectives, the business scenario, the external reconstruction will be happen to overcome the financial crisis. So businessmen and industrialists and business world and corporate world, there is a external reconstruction is a normal and common method to overcome the financial crisis. In a external reconstruction, the old companies will be liquidated technically and new company form with the same shareholders. Typically, assets and liabilities are transferred at agreed values in the appreciation of the assets and depreciation of the assets to business newly established with the new ideas and concepts to overcome the long-term debts crisis and losses situations. In this situation, the long-term loss will be written up after the newly external reconstruction of the procedure. In this situation, all the business, its whole mishaps, old losses and old crisis will be clean in the new balance sheets, and the business will be work fresh and newly going concern. In this situation, it will be arise due to the heavy losses in the business, overvaluation of the assets, and poor creditor confidence among the suppliers of the business. Features of the external reconstruction. External reconstruction, there is some kinds of the features. So business can easily survive into the business world. In this situation, the old company will be liquidated and new company formed with the same share capital, and fluctuation in the assets valuation. It will be the appreciation and depreciation of the assets. Transfer of the assets and liabilities to the new companies, it will be the procedure of the external reconstruction. Then next procedure is the shareholders involvement. The shareholders of the existing company, that is old company, usually given the shares in the of the new company in the exchange way. The purpose of the external reconstruction, the purpose of the external reconstruction is to help the business to survive in the new business situation with the new ideas, and remove the losses and clean the business with the new business scenario. Examples of the business scenario: suppose a company has been incurring the heavy losses with heavy debts. In this situation, the balance sheet misleading the business situation. So in this case, the business decide to going towards the external reconstruction. In this situation, the just reorganizing the accounts in the internal reconstruction of the company. So old existing business will be dissolved or liquidated and form a new company to carry forward the business under the healthier business financial condition. This is a so commonly in these features are involved in a business scenario. This is a external reconstruction of the business. Objectives of the external reconstruction: the external reconstructions have the some objectives to form a new business. So some kinds of the objectives are basically as below. First, to write off the accumulated losses. Suppose there is a preliminary expenses, there is a losses of the last years. So these losses are typically 10 to 15 lakhs. In this situation, the balance sheet of the business doesn't show the proper business scenario. In this situation, the businessmen have the suppose require the share capital. In this situation, though no one can be ready to provide the share capital to provide the funds to the business. In this situation, the businessmen have the options of the external reconstruction. Second objective, the fresh capital infusion. In this situation, new capital will be raised in the external reconstruction process. Newly share capital will be issued to the shareholders, and business setup will be infused with the new blood of the share capital. Third objective is improve the debt equity ratio. Suppose we have the called the we have suppose we have calculated the debt equity ratio. The debt equity ratio formula is total assets divided by total liabilities. In such a case, so liabilities are more than the assets, so debt equity share ratio doesn't show the proper business situations. In such a case, there is availability of the funds, there is availability of the raw material and suppliers opinions towards our business. It's maybe the negative. In such a case, to improve the debt equity ratio, the businessmen have the options of the external reconstruction. The next fourth number objective is restore the creditors shareholders confidence. Suppose the business situation is not a proper and mislead the business mislead by the balance sheet. So in such a case, the creditors and shareholders doesn't rely and doesn't depend on the business, doesn't show the their commitment toward the business. In such a case, no one can provide us the raw material. In this situation, the shareholders will be sell their shares. In such a case, there is a crisis of the funds, so external reconstruction is required. Clean balance sheet for future profits. In external reconstruction, the clean slate will be shown, and so all the liabilities are revalued, all the profit and loss balances are written up. In this situation, the clean balance sheet will be shown. Though those people, those external stakeholders shows our business and new and attracts towards our business. In this situation, external reconstruction is required. Then comparison of internal reconstruction versus external reconstruction. In a heavy losses, we require the internal reconstruction, but there is a last some years we have the losses. In this not a major losses, we have the external reconstruction. So these are the two main basic differences between the internal reconstruction and external reconstructions. The first aspect of the external and internal reconstruction, the company status. In internal reconstruction, business continues, but in external reconstruction, there is a liquidation of the business. Then second aspect is new entity. In internal reconstruction, there is no need of the to form a new business. There is a internal reconstruction. In case of the external reconstruction, there is a new formation of the business. Newly shares will be issued. there is a return of the old losses. In third of the aspect, the losses, set of future profits in case of internal reconstruction, and in case of external reconstruction, there is no provision of the set of external future profits, but it will be carry forward. It will be the return off, return down all the losses and accumulated losses and other debts. Then complexity, the aspects toward the internal reconstruction, there is a simple resolution for the internal reconstruction, but in case of the external reconstruction we require the permissions of the equity shareholders, because their shares value will be declined due to the internal external reconstructions. There will be fears about the external reconstruction, so there is a various complexities, various difficulties will be arise in the external liquidations. The cost of the internal reconstruction is very low, but in case of the external reconstruction cost is very high, so liquidators charge the fees of the external reconstruction procedure. Comparison between the internal and external reconstruction, the next aspect is company's continuity. Same business continues in case of internal reconstruction, but in case of the external reconstruction, old company liquidated and new company required to form. In this case, the old company's shareholders passes the resolution of the to liquidate the business, and new company's registration is required from as per the new revised Companies Act 2013. So this is a lengthy process. Shareholders position, in this case, in case of the internal reconstruction, the shareholders of the old company retain as a existing business, but in case of external reconstruction, shareholders exchange the shares with new company shares. So there is a fear of the decline the value of the share value or face value. Legal complexities, in case of internal reconstruction there is a less complexities, but in case of external reconstruction more complexities are required, so lengthy legal process are arise in the process of external reconstruction. Purpose, the internal reconstruction purpose is adjust the equity, adjust the capital structure, but in case of external reconstruction, transfer of business to a new business entity, it is not easily possible. Legal process of external reconstruction in Company Law 2013 and earlier Old Companies Act 1956. External reconstruction required the legal and financial process, and there is a resolution from the shareholders and other stakeholders of the business. In this case, in this situation, existing business transfer to its new business, usually to overcome the financial difficulties or restructure the operations. The old company is liquidated, and shareholders of the old companies become the new shareholders of the newly formed companies. So there is a structural breakdown in the external reconstructions. Key steps in the legal process. While we start the process, there is a first process to pass the resolution in the board of directors meeting. The board of directors of the old company, that is existing company, proposes the reconstruction process in the board of meeting. All the board of directors, majority of the take the decisions is required. So if the majority decision is not taken, so the legal process will be stopped and hold by the board of directors. So in such a case, there is required the majority of the decision, major 3/4 of the major resolution in favor of the external reconstruction. Draft the scheme of the reconstruction is required. So how two shares will be exchanged, how the liabilities are valued, how the assets are valued. All the scheme of the reconstruction will be drafted in the procedure of the external reconstruction. There is a approval from the shareholders, approval from the other stakeholders of the business who are responsible of the business of process of external reconstruction. A special resolution is required in the annual general meeting or a special general meeting to pass the resolution of the external reconstruction. If the shareholders are agreed to exchange their shares, the old company can start the external reconstruction. But the old shareholders are not agree with the external reconstruction process. The old company doesn't work the future and other legal process will be stop of the external reconstruction. So shareholders need to agree with the proposal of the external reconstruction procedure. Creditor consent is required because creditors provide us the funding to the business in the form of the raw material, in the form of the um, bank loan facilities, that is bank overdraft. So creditors permissions is must be required because they are the fund raisers to our business. So especially the debts are being restructured or settled differently, formation of the new company. In a external reconstruction, there is a formation of the new company is incorporated under the Companies Act 1956 and Revised Companies Act 2013. Memorandum of company and articles of association. The both main documents are change in such a case of the external reconstruction. Without the changing in the memorandum of association and articles of association, the external reconstruction process cannot be complete. Key steps in the legal process: liquidation of the old company. There is a requirement of the to liquidate the old company, and then afterwards the process of external reconstruction will be start. Liquidators of the company, old company, will liquidate and revalue all the assets and claims of the business and transfer procedure of the business. This is the next method, next procedure. Issue of shares in new company. The shareholders of the existing shareholders of the company give the new shares so they can easily accept the procedure of the external reconstruction. Because this ensures the continuity of the ownership, and they positively yes to in the favor of the external reconstruction. Approval by the tribunal. In such a case, the external reconstruction procedure, the old company required to pass to get the permission from the jurisdictions. The supreme in this scheme, the must be sanctioned by the National Company Law Tribunal (NCLT) or equivalent authority to ensure the fairness and compliance of the procedure of external reconstruction. Transfer of assets and liabilities. In this process, the liquidator of the company, of old company, have the rights to transfer the assets and liabilities with the revalued prices. The old company legally transfer the old of its own asset to the new company with the agreed value. In this process, the proper valuation must be required with the legal documents of the properties. Legal consideration. Compliance with the Companies Act. All the procedure must be adhered to statutory provisions. Protections of minority shareholders. Safeguards are required to prevent the exploitation in the process of external reconstruction, to save the rights, to save the property rights of the minor shareholders who have not completed their age of 18. Tax implication. Transfer of assets may attract the stamp duty, so stamp duty must be paid to the proper authority. Then capital gains tax and other levies must be paid through the proper procedure following the accounting statements. where there is a proper valuation of the assets. Regulatory approvals, it depends on the apex body of the companies act, or other apex bodies like as a SEBI, Security and Exchange Board of India, Reserve Bank of India, and other regulatories must consent, must require the consent of the external reconstruction of the companies. To know the suppose we have the proper theoretical aspect, but as well as we require the practical aspect of the external reconstruction, how the external reconstruction going on. In such a case, we have the practical example to understand betterly of the uh, external reconstruction of the company. In this problem, we have the data of X Limited. So X Limited balance sheet on 31st March 2026. The X Limited undergoing the external reconstruction. In such a case, the X Limited have the equity share capital 50,000 shares of rupees 10 is, that is a 5 lakhs rupees. Reserve accumulated losses, there is a 3 lakhs rupees. Then 12% debentures rupees 2 lakhs, creditors rupees 1 lakh 50,000. Then building 4 lakhs rupees, plant 2 lakh 50,000, stock 1 lakh 50,000, debtors 1 lakhs rupees, cash 50,000. The total is 5 lakh 50,000 both sides. Then in the other side, the reconstruction scheme, the assets taken or at building 3 lakhs rupees, plant 1 lakh 50,000, stock 1 lakh rupees, debtors 80,000, cash 50,000, liabilities of debentures 2 lakh, creditors rupees 1 lakh 50,000. Purchase consideration taken as assets minus liabilities, that is a 3 lakh 80,000 as the net assets. Purchase consideration. X Limited, that is new company, issued the shares of 38,000 into 10 rupees per share, that is a 3 lakh 80,000. Then realization account we made, all the assets and liabilities are transferred to the realization account, because old company will be closed after the external reconstruction process. So all the assets are transferred to the debit side of the realization account, and all the liabilities are transferred to the credit side of the realization account. Here is the valuation of the assets as per the book values. Then creditors will be transferred to the credit side of the realization account. Then X Limited 6 lakh 80,000, this is a our PC. Then new balance sheet is made, the as per the values mentioned in the balance sheet of earlier balance sheet. Then 38,000, this is a 3 lakh 80,000. Then others are the reserves and accumulated losses. Key takeaways: while we external reconstruction, the old company liquidated uh, and new company will be formed. Realization account shows the true assets values. Losses cannot be carried forward to the new company as per the rules and regulation of the external reconstruction of the companies. The NCLT approves the mandatory for the scheme. There is a mandatory procedure for the to get the permission from the NCLT. Shareholders get the fresh shares in the new company. Thank you.